Welcome to Retail Retold, the stories behind how that store landed in your neighborhood. I'm Chris Ressa, in conversation with the people and stories shaping retail and real estate. Brought to you by DLC. Welcome to Retail Retold, everyone. Today I'm joined by Jack Rosencrans. Jack is the Vice President of Development at DLC. Jack, welcome to the show.
Chris, glad to be on.
So today, everybody, we are going to be talking about a recent development deal that we did at DLC, and a little unique for DLC. It was a self-storage deal that Jack ran point on, and it's going to be an exciting one. But before we get to that, Jack, why don't you tell everybody a little bit who you are and what you do?
Sure. So, as Chris, you mentioned, I'm the Vice President of Development at DLC. It means a handful of different things depending on the day of the week. So, we have a pretty robust in-house leasing construction team. There's a handful of projects that maybe fall outside of the vanilla definition of releasing space. There's projects where maybe retail doesn't make the most sense for a particular project, and there's an opportunity to look at other uses, other opportunities within a project. So, um, there are solar deals that we're working on for rooftop leases. There are outparcel developments, preferred development deals, and in this case, self-storage opportunities, where we think there's maybe an opportunity to pursue uses outside of the traditional retail scope of what DLC excels at, and trying to find the highest and best use for general real estate opportunities. So I have a history working in retail for a handful of larger REITs, and coming to DLC, had an opportunity to leverage that experience and work on sort of all things real estate, which has been pretty cool.
How long have you been at DLC?
Been 4.5 years now.
Oh boy,
Yeah,
long time.
yeah.
Um, so let's talk about this self-storage development deal. Um, and it's in Columbus, Ohio. But I'll start off with, I thought DLC invests in retail real estate. What's going on? Why self-storage?
So I think that throughout the industry, self-storage has been historically looked at as an afterthought of an opportunity. And I think in the past, call it 5 years, a lot of the institutional investors have realized that it's a pretty opportune moneymaker. So um, we've had a handful of opportunities throughout our own portfolio to look at alternative uses, maybe a big box where the space isn't naturally backfilled by a large, called 80,000 square foot retailer. We've gotten pretty educated on self-storage as a general opportunity. Um, a lot of things have to align in terms of the market being, uh, the right level of saturation in terms of supply and demand, the zoning being aligned, the uses and restrictions by other tenants being aligned. But through that process of looking through our own portfolio, we've found, uh, I think we've discovered that self-storage is somewhere where we could utilize our in-house construction, in-house development capabilities, and find somewhere where it makes sense for us to do it ourselves. So it's a pretty interesting industry because at the end of the day, it's a commodity good. It's a storage shed where people put their stuff, and so long as the data and the demographics align, it generally fills up and generally stays filled up, cash flowing as a real estate asset.
So, got it. Thank you. So, right now, globally, how's self-storage doing?
Yeah, yeah. So coming out of COVID, or I should say during COVID, self-storage exploded as an asset class. A lot of people were moving out of their apartments into their parents' house. They were traveling the world. They were putting all their stuff in storage, and occupancy spiked, asking rates spiked, rental rates spiked, and as an industry, it was on fire. So there was certainly a moment in time where everything came back to earth from, call it, 2023 onwards, where everything regressed back to the mean of where it had been pre-COVID, I would say. So, um, generally speaking, you don't have the same occupancy levels, you don't have the same rental levels as you saw during that prime COVID moment in time. But as an overall industry, it's still very healthy. You see a lot of occupancy rates in the right markets in the mid 90s, um, low to mid 90s, where, like I said, a lot of people, Americans in particular, store their stuff in storage and tend to keep it there for a long term. And over time, these national operators, national managers, they'll raise your rent. And a lot of people will say, I'd rather pay an extra $10 a month than spend a weekend of my life moving stuff out of a garage or figuring out what to keep or what to throw out.
Sure. So why Columbus?
Yeah, so Columbus in general is a market that DLC has liked the look of. We've made a couple recent investments there. Um, in this particular opportunity, we saw that it was pretty undersupplied from a self-storage perspective. So, as a general rule of thumb, the idiot's guide to self-storage is that if you have a self-storage supply of, you know, rough numbers, 7.5 square feet of self-storage per capita, you're at that level of saturation. Now that can fluctuate a lot depending on the local markets, right? Relatively high income markets can tolerate a lot more than that. But this particular market where we identified a parcel, we were at 5 square feet per capita. So we thought that there was one, an opportunity to add additional supply into the market, and two, the zoning aligned in a way that we felt there was a reasonable chance of getting approvals to pursue it as an opportunity, to get the rights to do it in the first place from a zoning perspective.
And the third piece that you spoke about, which is we are very much fans of Columbus. We've made recent investments over the last couple of years, multiple in Columbus. We really like this as, one of the top Midwest markets. Um, so that all aligned, no doubt. So you we decide that Columbus is a market. We find the right site to do it at. What happens next?
Um, so this being our first foray into the self-storage space, there was quite a bit of scrutiny around which consultants to work with. How do we design the right site? How do we get the right market mix? So there were a handful of feasibility studies that we did to make sure that the site is actually going to work from a self-storage perspective, make sure that it's going to fill up once we build it. So we hired a couple local consultants who have experience in the space, helped create our site plan. It took the better part of a year to actually get site plan approval in this particular municipality. So we were in a municipality that, it's a smaller township, but it's within the larger Franklin County, which is the county that encompasses the city of Columbus. Coming out of COVID, this is not unique to Columbus, but they were short staffed. They had longer approval timelines, longer turnaround on comments. We, in this case, had to get a conditional use approval for self storage as an opportunity. It was a former commercial retail site with self storage as a use that's conditionally approved so long as you satisfy a handful of conditions. So we had to go before a board of zoning appeals, certify that we were going to satisfy those handful of conditions. And coming out of that favorable meeting, sorry, the favorable vote at that board of zone of appeals, it took us 9 to 10 months to get the actual planning department to stamp the approval on our plans. So, um, it took quite a bit of planning and strategy around what's the right market mix, what's the right layout, what's the right level of asphalt to, green space on the site to minimize operating expenses, to take advantage of the fact that, hey, a lot of the competitors in this market today, they have a mix of drive up units and climatized, interior storage units. What's the right market? What's the right mix of unit sizes and mix from that perspective? And I think, in this case, it being our first market, it was smart to lean on some of those consultants who have done it before. We're hopeful that it was the right combination at the end of the day, but so far things are looking good.
So, okay, so we spend a lot of time in uh, design phase. What about the underwriting phase and like making it work? Because we're in a time where very few people are developing ground up. This was a ground up real estate deal.
Yeah, so I would say that very rarely do you reach out to consultants and operators, look at a site for self-storage, and they say, this is not going to work. There's a lot of positivity and optimism around the ability of a storage facility to fill up, which as a new developer in the space, I think was warranted a healthy level of cynicism of saying, is it actually going to fill up? What's the right approach to take from an underwriting perspective? So the first thing that we found was between brokers involved in the space, operators involved in the space, and third-party consultants, there was a good level of consistency in terms of how people felt it would perform. So we use that as a good basis for establishing a leasing cadence, a market rent, and establishing our own internal level of underwriting. So when I say operators provide their own underwriting on this, it's really the national groups like CubeSmart, Extra Space, Public Storage, and then some more regional groups that give you their analysis of how they feel the thing's going to perform. So um, for us, for DLC, we knew that we weren't going to operate it ourselves. We typically operate our shopping centers ourselves. We handle the own leasing and property management. In this case, we really wanted a name brand behind us. And so we knew at the end of the day, we were going to select from one of the larger brand names in the self-storage operation space. In this case, we did end up hiring CubeSmart to manage the facility, but um, we did lean on a lot of those groups to provide us some guidance on how the thing would perform. And that was the process on that side of things. And then on the construction side, similarly, we have an in-house construction team that hasn't necessarily built self-storage before, but has a lot of relationships in Columbus, has a lot of the groups to reach out to who have built in this space. And so we felt a good level of confidence having that capability in-house to get a handle on what does it cost to build this.
So you underwrite the deal, you buy the land, you get the design done, and you're off and running, and you built it. Any hiccups along the way?
Yeah, so I would say at the time that we started this project, I think we first started talking about it in summer of 2022 when the world of self-storage was still on a high coming out of COVID. So there were quite a few um, reality checks on the revenue and operation side of the thing of the actual pro forma. And then on the construction side, um, we came out of the site plan approval, building building drawing and building permit approval process and said, is this really the right time, the right opportunity to do this? So what we did was we went back to our construction team. We said, we really need to value engineer this opportunity. We need to figure out where we can save money. Um, and we took a pause for 6 months, starting in spring of 2024, and said, how can we get the prices down to justify this project from an opportunity that makes sense relative to the level of risk that this is going to take. So we had building permits ready to construct in spring of 2024. We had pricing in hand, and we said we need to value engineer this thing. And by the way, relative to 2022, the world of self-storage is not looking the same as it was in 2024. And uh, we recognized that if we had started construction at that point in time, we were going to be opening a facility heading into the middle of winter in a relatively challenged moment for self-storage. And so we pressed pause. Our in-house construction team came back and said, we've identified the right local contractors. We found opportunities to save money. Um, and going into the fall of 2024, we were ready to pull the trigger based on updated numbers on both the revenue and construction side. So at that point, we expected to, with relatively conservative underwriting, again, because there was that healthy level of skepticism, we expected to come out of the project at a 9% return on cost at stabilization. It would take some time to get there because it takes some time to lease these facilities up, but at the end of the day, we expected this thing to stabilize at 9% return for an asset class that typically trades at stabilization in the 6% cap rate range. So there was a pretty healthy spread there in the opportunity to make money.
Got it. So, um, we didn't want to come out of the ground. We didn't want to deliver self-storage in winter. Some, you know, a lot of noise in the air about self-storage for a moment in time. And so we tasked our in-house construction team to value engineer it. They came back, said, Jack, I was able to solve it. Our in-house construction team, Renovo is the name of the general contractor. Renovo came back to you and said, Jack, I got some savings for you. After that, you revise your numbers, your underwriting, you put together a meeting and you pound your fist on the table and say, let's go.
Yeah, of course. No, it's
Awesome.
yes, it's a it's again an industry where you trust a lot of the data behind what makes sense. So, like I said, we were undersupplied in a market that, based on the data, needed more self storage. Based on the handful of consultants said that it would perform. Right, we had 7 different people that all had relatively consistent underwriting. And in summer, it was July of 2024 that we said, we think these numbers all make sense. We should go do this project.
And so taking a step back for a second, the you were mentioning the data around the self-storage business, and I had I had gone with you to a meeting to at CubeSmart's corporate headquarters and watched a presentation on some of the data they have, which was pretty fascinating, a little bit different than the retail space as it relates to the data and understanding their end consumers. Pretty interesting. That said, I think in any commercial real estate asset class, industrial, retail, multifamily, building to a nine is pretty challenging in today's environment. So obviously you had the ability to do that because Peyton or Renovo helped lower your construction number. Um, but like when I hear you're building to a nine, what I think of is like, well, that must mean that, you know, rents are really strong here. Or what else helped? Because it's hard to build to a nine in anything today.
Yeah, I think, ultimately this is a market. The site we're operating on is not a particularly high end market from a rent perspective. It's not a high income market in the local population. So it was really being able to execute on delivering a project at the right basis, at the right cost basis. So tying up the land for the right price, building for the right price, being able to actually build to budget and greenlight the project with a level of confidence that we could deliver based on those numbers that we had ahead of time. All in, this is a project that, including carry costs, including interest reserve, including a development fee for DLC, we're all in at the project on $100 a foot, on $100 per rentable foot, which is the name of the game in a project or in a local market that doesn't have the highest rents. Right, we're in mid-teens, whereas a lot of the other developers out there in the self-storage space, their checklist starts with our local rents in the 20s, and this is not what that is. So it's really, in this case, being able to control the cost side of the balance sheet.
Got it. And so you mentioned CubeSmart. How did you go about, there's a lot of like unbelievable we made a decision in house that we wanted to use a third party storage operator. There's a lot of storage operators that are really good, Extra Space and CubeSmart and Public Storage. How did we land on CubeSmart?
So CubeSmart had a presence in the Columbus market. At the time, they had 11 stores, but none in this particular portion of the city around the northeast quadrant of Columbus. So they were hungry to get into this particular part of the market, and they had operating capabilities locally. Um, they also I think one of the determining factors for us was that there's an extra space relatively local, you know, a quarter mile away from our site, performs very well. It's owned by Extra Space. And I think in this instance, we were hiring a third party management company. We felt more comfortable, at least in our first project, going to a group that didn't have a conflict of interest directly with themselves. And then more on the operations side, I think a lot of these national groups have the capability to perform pretty well. They all have a pretty robust marketing uh, practice, right? They have a lot of search engine optimization in house. They have relatively good brand recognition. So from a performance perspective, we felt comfortable that they were going to perform really well. I think we were pretty impressed by their in-house presentation about their revenue optimization capabilities, their data that they have in-house, and being able to pick a group that we could really partner with, and feel that they were going to drive the leasability and the rates on our facility, in our best interest and not necessarily conflict with some of their other sites.
Yeah, I was really impressed with that whole algorithm that showed the best balance of rent and occupancy based on what's going on in the market. That was super interesting. And like when you're at this level of occupancy based on what's happening, here's like some things, what should happen with the rent. When you're at this rent level, here's what you need to do with the occupancy. It was super interesting. Um, and so did you build this in cash? Is there a loan? What's the story?
Yeah, so we hired a local broker, with a self-storage niche expertise. So he's based in Columbus. Um, we ultimately felt that was the right avenue for finding debt financing for this project relative to other self-storage projects and other self-storage lenders. This is a small project. You know, it's a loan in the range of $5 million. Again, in a market that doesn't necessarily check the box of the prototypical self-storage development group. So it took some local knowledge. It took someone who was relatively smaller on the lending side. So we had talked to a handful of groups who said, we don't make loans smaller than $10 million. We don't make loans in markets that don't have that have lower than $20 rents. And so we really need to identify the local group who was familiar with this submarket and was familiar with, frankly, just lending on this project. Um, and so we went with a local Columbus-based lender, who gave us a construction loan and some leeway to operate the facility for the first called 2 years, while the project's getting leased up. So so far it's been great, right? We're through construction, like I mentioned, we're on budget, and we've had a good relationship with them, and they've been excited to get into the self storage space because they're not traditionally self storage lenders, but they're Columbus based and like the industry in general, um, like doing business with the DLC, and ultimately was probably the right group for us to work with on this case. There were a handful of other groups that submitted term sheets. This was the group that uh, I would say gave us the best terms and the best level of flexibility for this our first project.
Got it. So you mentioned you're through construction. Is it open?
Yeah, we opened 5.5 weeks ago. We get daily updates that we have some fun commentary on to see how many rentals happened the day before. But through 5 weeks, we are 50 units rented, which is ahead of our underwriting and ahead of our budget. So we're happy with the performance so far. It is luckily we were able to open in the month of April, which it was pretty critical to us. We started construction in September and really fast tracked actually executing on the construction in time to open for the lease up season. So uh, right, we haven't been through the January lease up yet, where things are pretty quiet in the winter months, but being able to open in April, being able to capture Memorial Day weekend, it's been fun to watch the daily activity because it's been a relatively robust lease up so far.
Awesome. Super, super, super interesting. Do you think DLC is going to build any more self-storage facilities?
Yeah, I think it makes sense for us. I think there's a lot of opportunity In the, I would call it opportunistic space where there's excess land, there's ability to do self-storage in the right market and the right opportunity. And maybe you do a hybrid concept with some retail in the ground floor, some retail in the front facing portion of the land that's on the street. So I think that there's an ability to leverage a lot of our capabilities in retail and now self-storage to find opportunities to do some cool stuff.
Excellent. All right, Jack, you've been a wonderful guest. Anything that we didn't talk about as it relates to self-storage, Columbus, or this specific deal that we should?
No, I think that's the full picture.
Jack, it's been a pleasure. Thank you so much.
Thanks, Chris. Thanks for having me on.
All right, just stay on for a second.
Appreciate you watching. Hit subscribe. See you in the next one.